Multifamily syndication is one of the most powerful wealth building tools out there, but most people don't actually know how it works. And it sounds really complicated as well. And that's the problem, is that most investors, most real estate investors, when they hear it, they get scared. They don't even pursue it. So that's what John and I are going to be doing today. We're going to be breaking down what multifamily syndication actually is and how it's actually a pretty simple concept, and how you can benefit from it, whether you're an active investor or a passive investor moving forward. John, it's great to be here with you.
So good to be here, Mark. It is interesting, right? This is relatively new. So in 2012, the rules changed here in the United States, which allowed multifamily apartment, or really just syndication investing in general, I'll say it that way, to become much easier. So I think it was a little bit later into Canada, but not much further behind. So, this is a brand new concept. It's not like it's been around for 100 years, in other words. And so I think it's good for us to sit down and kind of slow it down a little bit and just break it down, because at its core, it is very simple. And what I love about it is that there was a period of time where, these apartment deals were really sort of only available to the large institutional investors, the hedge funds, the pension, you got pension funds, you've got groups like Blackstone that own billions and billions of dollars of these deals. And so in a sense, it sort of democratized this style of investing and allowed folks like you and I and other, and I will say, candidly, it is sort of high net worth individuals due to the accreditation requirements, but it's made these more easily available, where you used to have to go get 20, $30 million if you wanted to go do a deal like this. And now you can come in sort of fractionally and get those great returns. So I love it because it's really helping folks, entrepreneurs, hard workers, but maybe not the ultra wealthy, get involved in these kind of deals and enjoy those returns that, used to only be for like the billionaire class, in a sense, right?
You nailed it, John, because a lot of the REITs out there, and this is where it was like a big eye opener. When the market was going up a few years ago, I was looking at the REITs and what their overall returns were. And I'm like, why is it still returning, 6, 7, 8% when the market was going up by 20, 30%? And so when you start to dig in, you realize that you don't get that dollar for dollar participation with who you're investing with. And so when you're in we'll say, a very strong and up and coming market, you want to be able to get access to the deal as a partner to benefit, to get that same upside. And with our deals, John, the way we structure it, as you know, is basically our investors get the first 8% returns from all the sale profit. And so the cash flow ongoing, they get all the cash flow. And then we top them up to make sure they get the first 8%. And then only after that do we do a 70-30 split up to a 15% return. And then from there, it's a 50-50 all the way up. So that means if the market goes up 20%, the investors are not only getting that first fruits from the deal, they're getting ongoing all the way up 50% dollar for dollar return with the operator. And so the syndication is we'll just say, a beautiful model to be able to participate, but to do it completely passively.
That's right. And I think, let's just like start simple here, like a syndicate, right? What is a syndicate? A syndicate is just a group of individuals or maybe organizations that come together for a common interest or purpose, right? So just demystify that term a little bit. That's all it really means. So we talk about a syndication, we're just talking about a group of individuals coming together. And so it's group investing, right? Multiple investors pulling their money together to buy something larger than they can individually do on their own. As I mentioned before, it's sort of allowing these groups of investors access to sort of institutional quality investments without being 100% responsible for the outcome, right? So once again, maybe you've accrued $20 million. Well, you don't want to go take all of that wealth and put it into one asset, right? So you can invest a little bit here, a little bit there, and diversify your risk, but still get those institutional returns. So it's really like a team investment, right? Like we're all coming together. There's the general partner, which we'll dive into, and the limited partner, but it is a true partnership. But I think just starting there, right? A syndicate is nothing more than a group of people coming together to accomplish a common goal. Mm-hmm. And so I think just that helps demystify the whole, what is an apartment? That's really all it is. Yeah. Just us coming together to work together to execute on a plan together.
Yeah. Group investing, team investing. I think that's like a really good way to put it. And John, you and I, we've gone back and forth because the word syndication is a little bit, we'll just say, a little scary. And, in the Toronto area, there were in the past syndication groups where they did new development and they didn't go well. Yeah. And so there were some investors that actually lost some money with a group that we'll just say wasn't too straight. And so, but there were new development deals. And so the word syndication has in some areas has a negative connotation, negative, we'll say, thought process when some people hear it. And the reality is all it is team investing. And so there's good deals and there's good operators, and then there's bad deals and bad operators as well. So we've gone back and forth. It's like, do we change that word for us, internal
Yeah.
language, instead of syndication group? And we came down to it. It's like, we're just going to call it for what it is, but we're
Right.
going to be able to explain it to our investors at the end of the day. But you nailed it, group investing or like team investing.
Yeah, that's right. It's funny though. I have to think because I like to read, and and just in culture, right? I mean, there was sometimes where like an organized crime outfit might be called a syndicate, right?
Yeah,
So I
yeah,
think sometimes
yeah,
without even reading subconsciously, that's like in your brain
yeah,
a little bit. But at the end
yeah,
of the day, that's all it is. So yeah, remember we were initially saying group investing, and
yeah.
but at the that just think about it. It's a team. It's a team effort. We're coming together. So key players, right? Who are the key players in the syndicate or in a syndication? So the first are the general partners or the sponsors. So you'll hear those words. You can use them interchangeably. So those are the people that are ultimately responsible for the day-to-day operations of the business, the property in this context. They're the ones that are going out, finding the deal, raising the capital to close, crafting a business plan, executing on the business plan, and eventually getting to exit. So effectively, the general partner operator is taking on more of the risk as the general partner because we have to source the insurance, the loan, right? So like Mark and I are personally qualifying for these loans as the general partnership. So that's what's the beauty for that limited partner, which we'll get to in a minute, is that they don't really have to do that work or take on that risk. Their risk is really limited to the capital that they invest in the deal. So a limited partner is a good position to be in. It's all about that limited partner doing the right research. You mentioned that group in Canada that did some bad deals. Now, sometimes those groups are really good at hiding things, right? But if you're thinking about investing with a limited partner, whether it's as a limited partner, whether with Faris Capital or another group, it's really important that you do deep research into those people, like check their LinkedIn pages, make sure you can, maybe even their social pages, right? It is the world we live in. There is more fraud and misrepresentation out there. It's easier now sometimes to do these things than it even was years ago. So do a lot of due diligence on that general partner, ask a lot of questions and confirm everything. We're an open book. We're very transparent. We'll answer any questions, but do that deep research. So super critical. So once again, that's the general partner. They're doing a lot of the legwork and basically taking on all the risk and responsibility of the day-to-day operations. Now, the limited partner, as I mentioned, their really role is to contribute capital. They receive the passive income, and then the profit splits when we exit the deal, but no day-to-day responsibilities. So limited partner investing is really ideal for that busy entrepreneur, that busy professional, doctor, lawyer, accountant, whomever, that is working 60, 70 hours a week running their business, but wants to enjoy the upside of investing in real estate without having to worry about it, without the stress of actually having to operate the deal.
You got it. And this is limited liability. That's why limited partner, it's not that you have limited profits, it's limited liability, limited partnership. And so limited partner, that's hat that's worn. Why entrepreneurs that are really busy, they're successful, they don't want to be sued. And so they want to be able to invest in a partnership, but they'd like to take that concern off the table. And so that's why these are structured so well, because if, say, a deal went sideways, the only thing that, which is still important, is the investment they make. That's what is at risk. There's no sort of further liability if there's a lawsuit that they could be pulled
Yeah.
into. That's something that the general partners take that, and they're responsible for that. So they do take that risk. And so there's the risk is on the general partner side, not on the limited partner side.
That's right. Say we're, pressure washing and a resident comes out and slips and falls and a lawsuit ensues. We deal with that. The limited partner, you'll know about it because we're transparent. We're going to update you on our investor call, but it's going to be all about what we're doing about it. You're not going to have to worry about getting served by an attorney, right? So we handle all that responsibility and take on all that risk. So let's talk deals, Mark. So how are these deals typically structured?
Yeah, so I kind of spilled the beans a little bit earlier in regards to our structure there with the equity split. So the way that we structure it is to basically hold us accountable. We sat down and was like, okay, how can we ensure that we take all the pressure off of our investors and put it on us? And so when we go and find a deal now, John, as you know, it's 1 in 300. 1 in 300 deals is what will actually check the boxes. And why we're so was hardcore with finding that shiny penny is because the way we structure it is that we offer our limited partner investors the an 8% preferred return, which means that the first fruits of the deal goes to the investors. So that means that we'll just say there's more certainty that they're going to get at least 8%. And then after that, then we've earned the right, Faris Capital has earned the right to participate in the profits on the back end. And that's when we go to a 70% of the next waterfall, or next bucket that's filled is for the limited partners, and 30% for Faris Capital, up until the point that the limited partners get a 15% return. And then after that, we hit a 15% internal rate of return for investors. That's 15% per year. Then there's that next bucket that goes all the way up to a 50-50. And so this is really, really powerful that we structure it this way, because majority of our profit when we do our projections, Faris Capital, is once we sell after 3 to 5 years. And so if we don't deliver, we don't pick the right deal, and we don't execute properly, that means that majority of the profit that we're projecting on the back end is not going to be coming in, which could mean, John, that we could be working 5 years and we just break even by the time we get there. And so we got to be really, really careful with the selection of the deals. And this structure is really built to hold us accountable, take a lot of pressure off of our investors. But it also is good because it shows the confidence in our deals to say, hey, listen, we're willing to take this risk on because we're that confident in our execution.
That's it. Yeah, 100%. And, it's worth noting that Mark and I personally invest in our deals alongside our limited partners. So we put some skin in the game as well. Not all operators do that. So that's one of those due diligence questions you need to ask any operator or general partner you're thinking of investing in. But to your point, Mark, we built it in such a way where we have to overperform to hit our goal, right? And so it goes back to that confidence, and why at this stage where we're sitting as of today, we're recording this in early June 2025, every one of our deals is ahead of our pro forma projections on net operating income and rent growth. And so we structure it that way so the investor always wins. And if we make a mistake, the investor still has some profit. We may make not, but that's okay. That was our mistake. We own it. So it's set up in such a way to reward those limited partners first.
Yeah, for sure. And for context as well, like when I started with Faris, I had this vision. We had gone in and we had brought 2 checks to 2 different deals, and we got to see, we'll just say, how these deals are being operated, 2 different types of assets, 2 different operators. And so that's where we really learned a lot for those first 2 deals that we saw. And then we said, okay, we're going to build Faris Capital. And from that point, as you had mentioned, John, every deal that we've taken on from start to finish, we're overshooting these projected rents, which it's just rinse and repeat now, rinse and repeat. And then those first 2 were really, hands on, and those deals will, they're going to end up well. But there was some really key insights and lessons that we got to see that other operators were maybe struggling with, and so we really built our whole philosophy from those. It was kind of a blessing in disguise, because all future deals they're built on a strong foundation, and they've been going exceptionally well.
That's right. So for the LP, right, one of the beauties of these deals is you're not just making money one way. There's actually a few different ways that you're making money as an investor in these deals. So first and foremost, we only buy deals that cash flow on day one. So we're typically starting distributions of that cash flow within the first 3 to 6 months. We're actually generally hitting 3 to 4 months, but we just have to make sure we get everything transitioned over. There's a process that takes place. We have to take on the other operators, contractors, work through that, set up accounting. There's escrow funds that are sent over for their security deposits. So we're setting up all of our accounting. So once that happens, we start those distributions, but we actually catch you back up to day one, because the cash flow was still there. We just had to work through some process. So that cash flow is return on capital. So from a tax standpoint, that's very advantage. You're just getting some of your investment dollars back. So in a sense, you're kicking the can down the road a little bit, because at exit, there will be a capital gains that occurs. But when that distribution comes in, it's treated much more favorably from a tax standpoint. The property is appreciating over time. That's why we love real estate as an investment in general. Land cannot be created nor destroyed. So the land itself is appreciating, the assets appreciating. So that's just that natural appreciation that occurs. And real estate is often that hedge against inflation, because as inflation rises, so does the value of real estate, right? But then there's the forced appreciation, which is really where the magic happens. And that's where we execute our business plan. We improve the asset. We look for opportunities to reduce expenses. That is a bit more challenging today with rising costs. But what we sometimes find is just management efficiencies. We can share resources across deals. For example, in Charleston, we have a number of assets now. So we can share team members, marketing, and things like that. But we can drive additional income beyond the rent, right? So as we renovate the units, we can charge more in rent. So that's one way to drive that NOI. But other things we can do is add more features and benefits for the residents. So things like valet trash, where someone comes twice a week, collects the trash from your front door so you don't have to haul it down to the dumpster. That's an extra other income opportunity. We could potentially set up a washer and dryer rental program. We could add sort of tech features like Ring cameras. So all these little things you can do to add that extra income. That's the forced appreciation. So you get the appreciation, forced appreciation. And then over time, as residents pay their rent, we're paying our mortgage payments. So we're pulling down the principal on the loan. And then fourth, right, the tax benefits. So tax is generally favorable from a tax standpoint because you get things like depreciation. In the US, you also get the cost segregation benefit, where we can separate some of the personal property out from the real property. That is only in the US, but in Canada, you still get some depreciation. And those returns are treated as capital gains, not at your normal taxable income rate. So just great investment opportunities, but four ways you get paid as a limited partner investor in these deals.
You got it. So the life cycle, if we were to break it down into the simple steps, there's a pre-launch. So the general partner goes and does all the research. They pick the right area. They select the deal. They build relationships with brokers to be able to get the deals. They negotiate it. And then they actually, at that point, they start doing all the due diligence on it. They go and create all of the deal deck, and they structure the deal in a way that they're able to package it up. They create the deal deck, and then they go out and raise the capital from their limited partner investors. And so there's the commits that come in, and then the funding, and then there's closing. That's the next step. We close on the deal, and then from there it's hardcore business plan execution. Now, some operators will kind of do it gradually. We are hardcore within that first 28 days. We want to do the bulk of the exterior work, call it our 28-day transformation. But the business plan execution is so important. And that's where we do the forced appreciation. We'll say Magic John that you had mentioned. And we go in and renovate units over a period of 2 to 3 years. And then we look to exit in that 3 to 5 year time frame. Now, along the way, we do distributions as well. They start, and then we look to sell in that 3 to 5 years. So to recap, you have the pre-launch, the capital raise, the closing, the business plan execution, distributions throughout the whole period, which generally start in that kind of 3 to 6 month time frame. And then we look to exit, and then rinse and repeat. We do it again.
That's right. Some common terms, right? So if this is new to you, these are some terms you're going to hear. Now, we're going to keep this pretty simple. So, if you want to go deeper on any of these topics or gain a better understanding or learning, you can go to fulloutinvesting.com. That's a resource we've set up where we have a 10-step process where we walk you through exactly how we structure our deals, from underwriting to broker relationships to our 28-day transformation and onwards. We have a sample deal deck, but most importantly, you can book in a time. So we'd be happy to just have a conversation with you about these to go deeper. But we're going to keep it simple today, just so you can get a broad understanding of what we're talking about. So the first is cap rate, which is effectively just the property's income return based on the price we paid for it. So, a cap rate of 5% is typically what you see in a good market for multifamily properties. But because some of the challenges that we've seen in the marketplace with the interest rates rising, one of our most recent acquisitions, we're actually in the 6% range on our cap rate, which means we're buying at a lower value because we're getting a good deal. So our plan is to improve that asset, and when we sell, hopefully sell at a lower cap rate. Net operating income, also you'll hear NOI, right? That's just your income minus expenses, to keep it simple. So that cap rate is a factor of your net operating income and the price and the cap rate. And so it's a triangle. And We'll include that visual here. So you're probably seeing it on the screen as we talk. Debt service, right? That's simply your loan payments. Now, the reason we bring debt service up is obviously it's important. It's a big factor, right? Because if your debt is such that, it's eating up all your net operating income, then that's not a good deal. And so most of the banks look for a standard debt service coverage ratio. So it's basically saying, generally you can see a range, but say 1.25 to 1.4. So your income needs to be at least 1.25 percent, of the mortgage payment. Then we have IRR, right, which is that internal rate of return. So that is basically your annual return with time factored in. It's kind of a complicated math formula. I can't sit here and just give you the formula, but there are calculators you can find online. A lot of our investors, Mark, as you know, they think more in terms of annual rate of return, but IRR is an important metric. It allows you to compare other investments against each other because there is a time value to money, right? If it's a 20% return, but it's over 10 years, or if it's 20% return over 3 years, the IRR will be dramatically different. So IRR is something you should be familiar with and gain more familiarity with. And then obviously equity multiple. If I put in $1, what am I going to get back? Our goal is to underwrite deals where we're close to, if not exceeding, a 2x equity multiple. So you give us $100,000 at the end of the investment. Our goal is to give you back 200, doubling your money. And then accredited investor, this is a key factor here. So both the SEC, the Securities and Exchange Commission in the US, and in the Ontario Securities Commission, this is broadly the same across all the provinces in Canada. You have to meet certain income, net worth, or liquidity requirements. So that's just a government thing. It's not something we control. We wish it wasn't there, but we have to abide by the Security Commission rules. So 200,000 in income. These are actually both the same in the U.S. and in Canada. But of course, when we say these numbers, if you're in Canada, think Canadian dollars. If in the U.S., think U.S. dollars, right? 200,000 in income or 300,000 with your spouse. Over a 2-year basis with a reasonable expectation that income will continue, or $1 million in liquid assets, not including your primary residence. So that could be investment accounts, other investments that you have that you could easily sell, or a $5 million net worth. There is a fourth, which if you're in a certain industry, you can qualify, but most of our investors don't meet that, so I won't spend too much time there. But that is a legal requirement. We cannot take investments from a non-accredited investor. And just to put a bow on it, this is not like a certificate you get from the government. You either are or you aren't. And so part of our process, we work with exempt market dealers in Canada. They have a very simple verification process. You go through that process once, and every year or so, they might have to update just to confirm your financial situation hasn't changed. But it's a very simple process, but you don't have to call the Securities Commission or something to get a certificate that you're accredited. It's just you either are or you aren't. We just simply have to verify that as part of our
Yeah.
process.
And John, so when you had said like we wish it wasn't there, and the big reason why I know you said that because we've talked about this before, is that when we're speaking with investors, and let's just say because there's $1 million in investable assets, that's one of the check boxes that you need to be in order to be accredited. They could have like $900,000,
Yeah.
and we have to tell them it's just like you can't invest in this deal,
Yeah.
and that's tough. And that's tough. So that's where, there's certain rules and, we don't set them. It's just, we follow them. Now, there are some extra steps from a compliance standpoint that we could take but that's where accredited, that's what our deals are structured as of now. So John, syndication, there's a lot of people that are doing this. More and more people are getting into syndication. They're realizing that they can actually go and conquer their own land and still get that same kind of upside investing in with a really great group, and they can participate just like they're doing it themselves. So, syndication is we'll just say it's a beautiful leveraging tool. Just like an entrepreneur hires people to do work for them, what our investors are doing is they're leveraging our time, they're leveraging us to basically, they're hiring us to go do the job. That's what they're doing.
That's right.
And so that allows them to go conquer their own world, and instead of having to spread out and do everything on their own. And so that's been working really, really well. So what else, John? Why are people getting into syndication here, and then we're going to wrap up.
Yeah, I think it's that ability to get access to larger professionally run deals, right? So, versus buying a single family residence, which is a great wealth building strategy, but you're taking on all that risk. The phone's going to ring at 3 a.m. when the water heater goes, sideways. And it could just provide a lot of stress. And to your point, a lot of our investors are super, super busy. They're entrepreneurs. They're out there building businesses. They have families. And so to add something else on is just going to create more stress and potentially right. At least for me, I'm somebody who likes to simplify my life, like fewer things to think about, fewer things to worry about. So there's important things, right? Like my work, my family are the priority. So that access to those larger professionally run deals and that ability to leverage others to get you those results is huge. Once again, you're passively investing. So your capital is working for you while you sleep without you having to put any effort or energy into it. And it is more scalable and tax efficient and aligned with long-term wealth creation. Because the way we think about it is we want to do such a good job for our investors, exceed their expectations, not only with returns, but with communication and service, that when we exit a deal and they get that 2x equity multiple, they could roll it into the next deal, right? And just kind of keep that wealth creation going. That's an internal goal of ours. The best compliment we get is that many of our investors are invested in 2, 3, and 4 of our deals, right? And so that is what it's all about. So it's leverage, I think, to sum it up, and it's access to deals that individually I couldn't do, you couldn't do, but in this group syndication model, we can do together.
You got it. And they're strong enough where, John, you and I actually come, and when we invest from the LP side as well.
Yeah.
And so we're eating our own cooking,
Yeah.
so to speak, right? Like we're eating the food out of our own fridge, so to speak. And I think that says a lot. And we needed to build a structure that was not just the same as what's out there, but was significantly better to the point that we want to invest in it ourselves. And so that's what we were able to create here, the team that we built. And syndication is the model. That's the tool or the vehicle that we use in order to be able to help more people and do it in a way that really helps the residents at the end of the day and just builds an overall better community. And, you feel good about investing in real estate, and that's the way it should be. And that's how we're running it. So we love and believe in you guys. Keep dreaming and investing big.